Now, I don't know what strategies you might implement now, but most people, they go long. They want to buy low and sell high. And the market is pretty much geared for that. But that's just one thing that you can do in the overall scheme of things. Over the years, I probably made most of my profits with the market going down, because it might take a long time for the market to go up, up and up and up and up, but man, it can crash really quick. And if you're on the right side of that, you can make some pretty good profits pretty quick in those type of environments, because we do go down. Whoops, there we go. Somebody else. Hello, Jeff. Jeff, are you here? Just want to make sure you can hear things that are going on. Okay, it looks like you're in here. All right. I'm John. I'm just gonna kind of keep. Oops, you're connecting to audio right now. Okay, I'm just gonna kind of keep going with things right now, but I'm just gonna go through some strategies. Now, again, I have a whole longer class where I really break this down, because I go through the theory and concepts behind them. Did we lose somebody here? Oh, I guess we're just okay. I use Zoom every day for the teaching that I do. I'm just not used to having more than one person at a time who's attending these things. I'm used to one-on-one lessons when I'm doing the Chinese children lessons. So I don't, could you imagine trying to do them in a group? I can't. Okay, there are strategies that allow you to take advantage of the market, not only when it goes up, which is what most people do, but also when it goes down, and even when it goes sideways. And what we want to try to do is to develop this real intense focus on market evaluation. What do we think is going to happen? And then we take that and then we look at the different strategies that might be available to us. So a strong emphasis is placed on evaluating market conditions in order to implement these strategies. And a lot of people that do these strategies, they may not focus that much on technical analysis. Or a lot of people that focus on technical analysis, they're just looking for other ways. They're pretty much only going long. At least that's been my experience. And there's also a specific money management approach. I don't hit that very hard in this particular class. I go into it really in depth in my online courses that allow you to limit losses, and we are able to take advantage of compounding. And basically, I call it the 20% and out rule. And bear with me as I kind of go through this. But basically, we get into a position, if we make 20%, we're out. And now we take that initial investment, the 20% that we just earned, and now we do the next strategy. And then we earn 20% on that, or lose 20%. And then we just go, and then we allow compounding to really do the heavy work for us. I do have a video in the course where I go through the theoretical power of compounding that's on YouTube, where if you do this numerous times and get like a 20% return 50 times, I mean, my gosh, that turns a small amount of money into millions in just 1 year. That's not very realistic, but that just shows you the power of what this can have for you. Because a lot of times what people do is they take their whole chunk and they put it into this strategy, or they might spread it across 2 or 3 different strategies or different vehicles. And then they just kind of play things out that way. And that can work. That gives you some diversification. But what I like to do is take, let's say you have, just as an example, $5,000. And you might break that into 10 different streams. And you have a track where you do your first position, you make your 20% or lose your 20%, then you go on to the next one, and then the next one, and the next one, and the next one. And at the same time, you're doing similar strategies, but different in the other tracks, all at the same time. Because you're not going to go broke taking 20% gains. Now, some of the strategies that I teach, you can make 200 or 300% in your gains. What I try to really do and promote is just shoot for that 20%. If it's working, you can add more to that position, but lock in the profits that you already have. Now, you might not agree with that, and that's okay. That's part of the critical thinking. You might have your own approach that you really like, and I'll try to bring that out as we go through this. So there are strategies that we can implement based on what to do, how to do it, when to actually initiate this. And I call them positions, because they're usually trades. And I talk about this in other places. I use the definition of a trade versus an investment, just like the IRS does. If you hold on to something for less than a year, that's considered a trade. If you hang on to something for more than a year, that's considered an investment, and they're handled differently from a tax standpoint. And so I just kind of stick with that same basic idea as well. And then when to end it. Now, what I've learned over the years is the entry point is the most important. If you do it right, it's like the rest of the whole position takes care of itself. That's why I place such an emphasis on getting in. We can always get out, but getting in a good manner and in a way that's advantageous to you, that's a little bit harder to do. And I have some approaches that I teach that are different than what a lot of other people end up teaching. Okay, every aspect of the strategy is planned out from the beginning to the end, even before the position is open. That's one of these sheets that I have, that if you're a member, you can draw this all out and you write it all down. And you say, this is what I want to go long in this position. This is how much I'm willing to risk before I admit that I was wrong. This is the profit that I want to get. If you're dealing with different kinds of investments that have time constraints, that's planned out all ahead of time, so you don't lose track of that. If you're using stop loss orders or something, that's all planned out. And then we take that at the end of this day, and then we transfer it to the next day, and then make any adjustments that we might want to make with that. So we look at our profit target, our loss acceptance, and we don't really want to accept those, but that's how it goes. And then any time factors that might play into this. If you're dealing with some option strategies, you've got to be concerned about the calendar and what's happening there. And then different options using calls and puts. I don't know what your exposure is to those. Most of the strategies that I do and I teach are based around options. And hopefully that'll become more clear as I go through this. It doesn't mean you have to do that. You might have your own vehicles that you want to use. You may not even be able to do that in the kind of investing that you're doing. If you're in a 401k or some kind of a retirement plan, or you have a Roth IRA or something that limits what you can do, you might have to go with different strategies for that. All right, different types of strategies. There's really just two types: directional, whether it be up or down, and market neutral, where we're chopping sideways. And we can take advantage of any of these market conditions. We just need to really know what's happening at the time we initiate these strategies. So the first directional strategies I'm going to talk about, these aim to make a profit by a move up or down. And if we're bullish, that means we're hoping that it will go up, or we can also say that we're long at that point. And bearish strategies, this is when the market is going to go down, or we might call this a short position. And then some of the guidelines. Now, this is where I'm a little bit different than other people. A directional strategy is only implemented if the market is looking to close, and the close is more important than the open. We want to follow the close. And if we're looking to go long, let's say, we're only going to get into that position if the market is up. And we're going to try to execute that position as close to the close as possible, because it's the professionals who are closing the market. Now, a lot of people think, well, if I want to buy a stock at 10 and it drops to 9, I'm just getting in at a better price. Well, what is happening on the charts to make it go down to 9? Just because it went down to 9 doesn't mean it's not going to go down to 8 or 7 or 6. You might be on the wrong side of a trend at that point. And so if we're looking for the market to go up, whoop, I'm hearing some feedback. We're only going to get in if the market is going in that direction. If we're looking to go short, we're only going to get in if the market's actually down. Now, sometimes it's a little hard to do that because you have these buy and sell programs that kick in right at the end of the day. You have these market on close orders that are executed. That's why you see a really big spike right at the end of the day. There's all this conglomeration of orders that are waiting to be executed, and that can really produce some kind of a skewing of the chart sometimes. So we're not always going to hit that exactly, but that's really what we want to do. And you may ask, well, what about if I wanted to go up and look at what I'm missing by waiting for the end of the day and we've had a strong up day? What I found personally is what you lose waiting to see how the market will close is far outweighed by what you'll gain by entering the market at a more beneficial time. That's just what I found out. So, but you may need to have that proven for yourself as well. A directional position is never opened at the beginning of the day. The amateurs open the market. And think about what's going on, especially tomorrow. Well, it's still today for you. No, it's tomorrow for you too. When we open Tuesday for the market, we've had a 3-day weekend now, and people have probably, after they get done with their barbecues and being with their families and everything, they're going to sit on their computer and say, I'm going to get in some of this stock. I'm going to get out of this. I'm going to execute this order. And they hit the button. Well, that order is not going to be executed until the open on Tuesday. And you've got this whole backlog of all of these orders that are just waiting. And that's why we get these gap up and gap down movements. And that's why we might get a move that goes down to fill the gap right after we open, because these are people that aren't watching charts. They're just putting money into the market or taking it out, and it may not really have any impact on what's really happening in the market. A lot of times during the first hour to hour and a half, I go for a walk. I don't even watch the market during that time because it's so crazy. I wait for later in the day. That's when the professionals come in and start doing what they want to do. And so that's why I want to wait until the day has had a chance to mature itself before I really get set to follow things. And that's why I may go live during the last maybe 30 minutes or 15 minutes or so. If as a member, we're looking to go long and the market's up and you're like, oh my gosh, what am I going to do? And then we go live and we kind of go through this as a group and we see if that's ultimately what you want to do for that particular day. And then positions are opened as close to the close as possible. If any of you deal with mutual funds, for years, the only way you could implement what I teach was by using mutual funds. And even index mutual funds have only been around since about the mid-70s. Now, mutual funds go way back, but John Bogle, if you've ever heard of him, he came up with the idea of a S&P 500 index fund. And people thought it was a total joke. It's like, well, who's going to want to do that? Well, it's become very popular. In fact, it's become so popular, now it's transferred over to being an ETF, and it's the most popular ETF there is. And it was also the first, the SPY. And we do a lot of things centered around that. And so just what may not look like it is all that good of an idea right now may turn into a good idea. There's been other things that have come and gone over the years. Have you ever heard of single stock futures? I thought they were going to be really cool back in the early 2000s. They've never really taken off. They're not all that popular. And there's different vehicles that kind of come to if it moves, the market wants to trade it. Okay. You never used to be able to trade the VIX. Now you can do that. Now I don't do that, but there are people that buy and sell based on what the VIX is doing. And we don't know. And there was a time when we didn't have weekly options available like we do now. It was only monthly options. And so things do change over a period of time, and we want to be able to adapt these things if they're to our benefit. And then if a position is losing, this is another thing where I might be different. You never add to a losing position. Well, it's like, well, but my average price for purchasing has just gone down. No. Do you want to throw good money after bad money? You don't know if it's going to come back. I've done this too. That's why I've learned this. Okay. You think, well, if it's at 10 and it's dropped down to 9, I'll buy some more. Now my average price is 9.5, and then it goes to 8. Now my average price is 9. Blah, blah, blah. You're just throwing more money after a losing position, thinking and justifying in our brains that, okay, our average cost is actually going down. And that's true, but is that really beneficial to what we're trying to do here? Okay, additional funds can be added if the position is moving in the desired direction. If you want the market to go up and you entered a position on Monday and it's going up on Tuesday, you might want to add to that position. But if it's going down, you don't want to add to that position. Then if it takes a couple more days and it's starting to go back up, then you might consider adding to that. If it's not going in your direction, then you don't add to it. And that really ends up limiting your losses a lot more. Instead of justifying things as it's going down, now you're taking advantage of things as they're going up or going in the direction that you want them to go. Okay, so some bullish strategies. And I just have a whole list here. And I'm kind of, as I've been saying, going to hit them at kind of a high level. This takes advantage of profits when we get a move up in the market. And we also call this going long. You can buy the SPY, okay? And I just rounded it down to 4,500 for the S&P. The SPY is at about 450. It's a little above that, but I just wanted to keep it limited. And you could do that. If you buy 100 shares right now, you're going to lay out 45 grand just for 100 shares. Now, the PMP, that's not PIMP, okay? It's just an acronym that I came up with. It's the potential maximum profit. That's what PMP stands for. It's basically unlimited. You could get into the SPY, and theoretically, the SPY could go to 20,000. There was a time when, look at where the Dow is at right now. When I first started getting into the markets, they were wondering if the Dow was ever going to go over 4,000 for the first time. And I actually was watching the market on the day that happened. And everybody was, and when the NASDAQ hit 5,000, and then we lost so much of that after 9/11, it took us 20 years to get back everything that was lost in the NASDAQ. But when you buy something long, there's no limit to how high it can go. So that's why I say unlimited here. Now, it may take 3 lifetimes, and you may pass this on to your grandkids and great grandkids before it finally gets to that point. But still, on paper anyway, the profit is unlimited. Another thing, when we look at the daily video and realize, okay, I think the market's going to go up, we can enter an S&P 500 mutual fund. And that's also unlimited. I don't have an actual price here because there's so many different index funds available. I don't know what their NAV is for any particular day. But as I was saying a little bit before, when I first started this was my only alternative. ETFs, they were around, and the SPY was around, but it hadn't really taken off in popularity yet. When I decided to switch over from looking at individual stocks to looking more of an index-based approach. And so I had to go out and find some S&P 500 index funds. Now, the company that I was using for a long time, they're called Ridex funds, where they have one-to-one type of mutual funds. They also have what I call juiced mutual funds, where if the S&P goes up 1%, this mutual fund will go up 2%. They even have some ETFs now that go up 1, 2, or 3 times what the S&P is actually doing. They're really enhanced or juiced. And you can do that. If you feel confident that the market's going to go up, the market does go up, you can get into one of these positions. If it keeps going up, you might want to consider adding to that position. And then these juiced ETFs or mutual funds, this also has unlimited upside potential, the possible maximum profit. So, because they could just keep going up and up and up. And just like the Dow has been going up. You could also buy a call option. I don't know what your experience is with options, but you notice when we lay it out for the SPY to buy 100 shares, we're going to put up 45 grand for that. I don't know about you, but to me, that's a lot of money. And I just don't want to be throwing this money into the market when I'm not really confident about what's going to happen. You could do another thing by buying a call option. And I just checked. This is based on Friday's close. The type of options that I look at, and a call option becomes more valuable as the price goes up. And based on Friday's close, looking out 30 to 45 days, that would be into October. The option that I would be interested in would be about $900. So, would you like to outlay 45 grand or $900? Okay, I think that kind of speaks for itself. And there's really unlimited profit potential. Now, you are limited by time because these options only last for a certain length of time. But remember, the idea is get in, make our 20%. In this case, it would be $180 and get out. And now we take that $1,080 that we just made and then put it into the next position. And we let compounding then come in and start to build that up for us. Then another thing you can do, and again, I don't know what your experience is with this, it's a thing called bull call debit spreads. Debit means you're buying something. These call, and we also do put spreads as well. These debit spreads, these are going to be cheaper to get into. You notice where a call option is $900. The debit spread that I was looking at basically involves buying an option, and just to make it easy, it's an at the money option. So it would be a $450 option, a call option. You would buy that, and that would be about $900. And then you would sell an option above that, and you would bring in money from that. And when you have your outlay and your inlay, the actual price would be about $600 for that one option contract. But this also limits your profit at the same time. You're not putting as much money on the line, but you're also not going to make as much as if you just bought an outright call option. So your potential maximum profit is $4,400. That's still pretty stinking good. Okay, but you're limited at that. You can't make more than that in this particular type of position. Is that making sense so far? I hope. Okay, and I'm going to kind of show some different things about this as I go through this. And then you can also sell credit spreads. So we not only can buy different debit spreads, we can sell credit spreads. And I'll have a chart to show you what you want to do. If we're going up, you want to sell a credit spread under where we're at right now, so that we're going up and up and up and up and up. You receive that money when you sell the credit spread. And the further up we go and the more time that goes by, the more worthless this credit spread you sold is going to become. When we buy a debit spread, we want it to become worth more money. When we sell a credit spread, we want it to become worth less money after we sell it. And think about that. You know, you want to sell something now for $100, where if you wait a few days, you wanted to sell it again, now you may only be able to sell it for $90. Okay, because we're taking advantage of what options have to offer. Can you guys still see me okay? It's getting kind of dark where I'm at right now. I'm just going to reach over here and turn on a light real quick. I get so wrapped up in what I'm doing, I even forget that the sun's going down where I'm at. Okay, so, and I'll try to, and I go into a lot of detail with this particular strategy, and this becomes all the rage at different times. There's option educators out there who they teach a lot about debit spreads because you have limited risk. The only thing that you can lose in that debit spread is $600. Where if you buy the SPY at 45 grand, you could lose 45 grand. That isn't a real easy thing to take at that point. There, now you can still see me. All right. But that's just another strategy that you might want to consider. But that's your maximum profit. When you sell that credit spread, that's as much as you're going to get. So when you sell a debit spread, you're going to have a profit or a loss, but you're going to have to wait for that to happen. When you do a credit spread, you're going to receive your profit up front, and now you wait over a period of time to see how much of that you get to keep, basically. And that's your maximum profit. Some people don't like these because they have a really skewed risk to reward ratio. You might make $200, but you're risking $4,800. Okay, now if you do it right, it doesn't have to be really risky, but these things can really blow up in your face if you're not careful. So you want to at least be aware of that. And then there's another thing called calendar spreads. And I don't really have any prices for these because you can really vary this out. But the basic idea is that you buy an option, let's say for October, that you actually buy that. So you're going to pay out that. And then what you do is you implement kind of what you would do if you're familiar with a covered call. It's pretty much doing the same thing, instead of owning a stock or owning the SPY and selling options against that, what you're going to do is you're going to sell further out options. So you have this base that you're working from, and let's say you own the October option, and then you sell the November option, and then that doesn't do anything. So you get to keep that money. And now you sell the December option, and then that expires worthless. And so then you sell the January 2024 option. You're still holding on to this October option as we're going along. Now, it's not, you have to play with it a little bit, but that's the basic idea, is that you're using a base for the calendar spread, but then you're selling these other options that are worth less and hopefully will expire worthless. You can also do a different variation of that where you buy a further out option, maybe a year from now, and then you're just selling these options month after month after month. There was one time I actually got to the point where I was at break even. You know, you sell 11 options in a row, you get to that 12 month, and that's paid for your whole purchase price when you initiated the position. And so these tend to be longer term in nature as well. And then you can also do a covered call. Let's say you do own SPY. Well, you might sell some options against that. You may want to implement this down the road. You may start off by maybe buying the SPY and then wait a little bit of time before you sell the covered call against that. Because if you've sold the right to somebody else to buy that from you at the price of the option. And so if that thing really gets moving to the upside, they're going to take your stock away from you. Now you're going to get your money back, but maybe that's not always the best thing to do. And so you might want to wait and sell some options against a position until you're seeing some profits. And again, this is a little bit longer term strategy as well. And then you also, and I recommend this all the time, it's called a married put. I call it protection. It can be insurance. Whenever I get into like an SPY type position, the second I get into that SPY, I'm also buying a put option at the same time. And that protects your downside limits at that point. And basically look at it like, and I have a video that I posted a couple of months ago where I talk about hedging or protection. There's an example that I use in that video from the stock ARK, ARKK, which is all the rage there for a while. And in early, I think it was January 2021 or so, somebody got into that and put their whole life savings into it. That was just about near the top at that point. And it's gone from, what was it, 150, 160 at the top. It got down into about 30 before, now it's starting to go back up. And my heart just breaks for people like that, because that doesn't need to happen. A large part of what I want to teach people is how to protect what you already have. We want to make money, but we can't make money if we don't have any money. So those times that we're wrong, those times when things go against what we hope will happen, we want to be protected against that. And so whether it's a stock, whether it's the SPY, when you're going long on something, and right away you want to buy a put option against that. This is why the VIX goes up and down. When it's going up, that means the market's going down and people are buying more protection on these SPX or the SPX positions at that point in their futures contracts. But that they don't want to do this because it bites into their overall returns, because it costs money for insurance. And we think about this, you know, for our houses, for our health, for our life. We have all different kinds of insurance that we don't even think about. But yet, when it comes to our investments, there are ways that we can insure these so that the worst that can happen is we get all our money back, or we have a small loss. Just like with insurance, you might have a deductible that you have to pay, where you pay the first $500 or $1,000 or whatever. And then after that, that's when your insurance kicks in. The same basic principle applies here, where you might lose something because the closer you are to your purchase price with your put option, the more expensive it's going to be, and the more that's going to bite into your overall returns. And so you might have a little gap in there that you're willing to lose, but then the option will pick up and take over. And think of it this way. If you buy a stock at 20 and you buy a put option at 20, okay, if the stock goes up to 21, 22, 23, 24, that put option is going to become worth less as time goes by. Okay, and that you just have to eat that as part of your overall returns. If you buy a stock at 20 and you buy a put option and we go down to 19, 18, 17, 16, you're going to be losing on your stock. But for every point that you're losing on your stock, you're gaining on the put option because it's now what we call in the money, and it's going to go 1-for-1 based on where it is in comparison to the price of the stock. So you're not going to make any money when this happens, but what you lose in your stock can be replaced by selling that put option, and now you're back to break even at that point. So this is another thing that I really want to get across to folks, because you might spend 20, 30, 40, 50 years of your life building up this portfolio. And if we hit another time like we did in 2022, and it gets worse than that, people are going to lose their whole retirements. They're going to lose their life savings. You know, what if the US and Russia do go to war? What's that going to do? Is that going to help the market go up? Is it going to help it go down? We don't know. What if the US and China get into a mix over what's happening in Taiwan? You know, we don't know. These things are kind of happening around us right now. And so we need to take advantage of what we see in our charts, but we also have to be smart about these things as well. Okay, this kind of gives you an idea. And these charts just scare me. I don't know why, but I've never been able to make much head or tails of these things. But this is a long call. This is when you think it's going to go up. And down here, let's say in this example, it's $200. And so you're having a loss of $200, right, when you buy that. So it's going to have to move up in your desired direction just to get you back to the break-even point. And then over a period of time, we're at 95, then 100, then 105. As it keeps going up, this option keeps going up in value. Now, at some point, this option is going to expire. Or at some point, according to what I do, if you paid $200 for this, we're looking at a $40 profit right here. That's our 20% right there. And so it doesn't have to go up all that much for us to actually get that profit. We take that, and now we can put that into another long call if the market is still going in the same direction. But this tries to chart out, if you're above zero, that's a profit. If you're below zero, that's a loss. And then the x-axis here is just telling us what the price of the stock is doing. And that's really how this operates as far as call options. So the big thing to take away from this is just know call options go up in value as the stock goes up. But there's a lot of other variables that are involved in the option price that we also have to pay attention to. There's a thing called the Greeks, and there's different evaluations that we have to do with the options that we're choosing. And I go through all this stuff in the longer classes that I offer. All right. Now, this is a really scary chart too. And if I may, what I'm thinking of doing here is I'm going to stop this for just a second and see if I can bring up a whiteboard. And I ask your forgiveness in advance. I write like a doctor. Okay, I'm not very good at this. I when I was dealing with doing the thumbnails for all the different videos, I'm like, oh my gosh, I'm just not artistic in that kind of way. Okay, let me just. I hope you can see this. Okay, load. Okay, I don't want to explore new tools. Let's see. Am I sharing this out? Let me try this again. Nope, I don't. I want to, okay. All right. So let's say this is how I usually do things, is that the SPY is at 450 right now. You can see how bad my writing is. Oh, good. You can also write on there too. Okay. So what I would do, and I usually look 30 to 45 days ahead. I'm not doing near term options. And that might end up being a weekly option. It might, oh, hey, you're all here. We can all draw pictures together. And so this is the option that you're going to buy at this point. This would be a call option. Okay. And if that's all you did, you basically have unlimited potential. But to help your price go down a little bit and what you're actually risking, you might then sell a 455 call option. Now, when you buy the option, money's going out. When you sell the option, the money's coming back in. And so this lowers your overhead. But at the same time, it also limits your upward potential for profit. You can only, if the SPY was to go way up above this, it doesn't matter. It might go to the moon. You're still topped out at this point at 455 when you're doing a debit spread. So there's some give and take with this kind of strategy. I like these. I do a lot of debit spreads. I don't mind taking less of a potential profit, because if I'm getting into this for $600, that's what, $120 a profit. I'm going to get out before I even get to this upper point. And then I'm going to take that money and then look for another debit spread to put some money into. So that's really what this crazy chart is trying to show us. And then what's the worst that can happen? Well, you have $600 that you've put into that particular position. And if the SPY just tanks, the most that you could lose would be the $600. So you have limited risk. You know what it is at that point, but you also have limited profits. But you're also paying less. You're putting out $600 instead of $45,000 to cover the same number of shares that you would be if you were buying the SPY. So it's something to consider. Just think of how you could do a lot of different positions this way if you're able to do this. You might be limited, as I said before, because of a retirement plan or 401k. They don't all allow you to do this kind of positions, because a lot of people have lost a lot of money with options. And one of the things, this just cracks me up, the reason why options were even created in the first place, they were created in the early 70s, and they trade in Chicago, was to give traders and investors a chance to protect their investments. That's why they were created. And so when somebody says, well, most options expire worthless, they're supposed to. You know, I mean, if we buy health insurance and you don't get sick, you're not going to get your money back. That insurance that covered you for that period of time, it's going to expire worthless. It was there if you needed it, but if you don't need it, then it's money that's part of life at that point. So there are cliches and there are potential words of wisdom that we're told when we start participating in the market that, yeah, it may be true, but that may not be the best answer for that. You know, when somebody says, oh, I never traded options, almost all of them expire worthless. Well, yeah. I mean, for one stock, or for the SPY, there's hundreds and hundreds of options that are available at any given time. And so, yeah, most of those are going to not be worth anything. They're going to do what they were supposed to do. And then when they expire, they just fade away. They just go away at that point. So, all right, let me come back over. Okay, let me try to do this and come back to where we were at. Okay, hopefully you can see this very fuzzy little graphic here again. But this just tries to draw out what you're looking at as far as potential profit, where you're long the call, that's something that you buy, and then you sell a call, so you're short the call, and then eventually you get to the point where you're at break even, but you're also limiting your upside potential, but at the same time, you've also limited your downside potential. So there's some give and take in this particular strategy. Okay, let's go to the next one. And then protection. This is what, and again, if I could teach one thing, if all these other strategies, let's say I was forbidden to teach them and I could only teach one, it would be this one. Just because it just breaks my heart when people put their money into something and they've got good intentions, like that gentleman that got into ARK. He's probably not stupid. He's probably a hardworking person, and he probably thought about this investment. He probably talked it over, maybe with a spouse or maybe some friends. He might have got some professional advice, and at the time, ARK was really screaming to the upside. It's just unfortunate that he got in almost at the top. These things happen. And since people aren't professionals, they don't watch this all the time, they're kind of victims of what happens after that. And so if he could have just implemented a put strategy, then the worst thing that could have happened is he wouldn't have lost his retirement. And that makes me really sad when those things happen to people. So in real life, the outcome is not always experienced. When we do these bullish strategies, we want to buy something low and then be able to sell it high. And that's what the market is geared around. If you look at a long-term chart of the Dow or the S&P, going back to the 1800s, it's pretty much straight up. Now, there's some really significant downtimes that are mixed into that, but longer term, the market goes up. And it's considered to be very patriotic and a very smart thing to risk on the future of America. And so people are willing to put their money into these investments, into these businesses, thinking that they're going to grow and they're going to have the earnings to justify higher prices going forward. But that doesn't always happen. Your timing might be off. And we might be going through a difficult time economically. The Fed might be coming in and raising rates, and the market sees that as negative. So things happen to get in the way of our plans. Put options can be used to act as insurance with the goal of protecting capital or profits. When you first initiate a position, that's when you're going in to try to protect your capital, what you initially outlaid for that investment. That's the initial thing. And you might make that a year in advance or 6 months in advance. There's a lot of different leeway with how far out do you buy this protection. The further out you go, the more you're going to have to pay. If you do it month by month, you might pay less, but in the long run, you might end up paying more. It's the old pay me now, pay me later cliche. But then if you start to experience some profits, maybe on paper, these are unrealized profits, where you bought it at 20 and now it goes up to 30, you're not going to be selling 20 puts anymore. You might want to lock in some of those profits. You might want to go ahead and sell a 30 put at that point. So you're not only protecting your initial capital, now you're locking in some of your profits if things go wrong that way. So there's different ways that we can implement this. And I wish more people knew about it. And I'm making it my mission to try to teach as many people as I can about this. So when a stock or ETF is purchased and you go long, the put option is purchased at the same time. When I do this, the minute I get a confirmation that I'm in the SPY, I'm immediately putting in my order to buy a put option as close to the price where I got in as possible. That's just how I do it. And that'll save you a lot of heartache. You might want to, sometimes we do things in life that 99 times out of 100 will be okay, but that one time out of 100, it could totally devastate our lives. And why not just try to play it as safe as possible? When I talk about stock market logic, there are things we can't control about the market. We don't know what rumors are going to hit the market. We don't know who's going to come in and buy or sell. We can't control that, but there are things that we can control, and this is one of them. And so why not take advantage of this? It'll help you sleep better at night. It'll help you just have more peace of mind. And when you're not under the gun and you're not doing things based on emotion, you make better decisions at that point. All right, I think I've harped on that enough. All right, if prices go down, the correct put option will increase in value by the same amount that's being lost in either the stock or ETF. And once you go in the money with that put option, which means if you buy a 20 option and then the stock drops below 20, you're going tick for tick up in value with that put option as the stock is going down. So it's pretty much going to replace what you lost. And then that's the goal of this whole thing. You may not make any money, but we're protecting what money we have in there. And then put options can also be used to lock in profits, as I talked about. As you're going up, you might have one option that you purchased for protection that expires, and then you go out and then you buy another option at a higher price because your stock has gone up. Now, if things go against you, you're protecting both your profit and your capital. All right, and it's also called a married put. There's a lot of different names for this, but these charts, I don't know why, but these kinds of charts just don't make a lot of sense to me, but they do to a lot of people. Where over here we have just if you bought the stock and it goes up in value, okay? And then if you were to buy a put up here, it will go down in value as the stock goes up. And that's really what we want. You know, we don't buy health insurance because we want it to kick in gear. We don't buy auto insurance because we want to get in a car accident. It's just there to protect us in case those things happen. And then here we have the strike price. And then as the stock is going up, the put will go down. But the inverse of that will also happen. If the stock goes down, the put price or the value of the put will end up going up. All right. Then some bearish strategies, some different things that we can take advantage of when the market goes down. It's a little bit more limited what I'm going to go through because there are some strategies that we do here that we do when the market's going up that I don't really implement that much when we're going down. And this we also call going short. You could sell short the SPY. Okay, I wouldn't recommend doing that. You know, short selling in and of itself is very dangerous. And a lot of people got wiped out in the 1987 crash because they sold puts, they sold short, and all of a sudden these things are getting optioned against them and they don't have the money to come up with it. Because you got to make good on these things when you're selling these things to somebody else. And if you don't have the money, you could lose your house. You could lose your business. You could lose everything if things don't go in the right direction. So there are people that do this. I personally don't do it. There are other ways that are a lot less risky where you can take advantage of things going down without taking on this additional risk. So your potential maximum profit is limited because as low as you can go is zero. You know, can't go below that as far as stocks are concerned. You could also get into an inverse mutual fund. There are mutual funds out there, Ridex, different companies out there, where if the S&P goes down 1%, the value of this mutual fund goes up 2%. There are those things available for you to use if you want to do that. And that's what I did for a long time. And I think I stopped short of my ADX story. I used to only be a trend trader. I would be long or short, and that was it until I realized that the market goes sideways. And then I had to implement additional strategies to be able to take advantage of that. But I did. I was either long or short pretty much all the time. You can buy inverse ETFs. There are ETFs out there that'll, if the S&P goes down, the value of this ETF will go up. They also have juiced or enhanced ETFs, where if it goes down 1%, the ETF goes up 2%, and they even have 3% to the upside. And the only reason I say these are limited is because as low as the S&P can go is zero. Now, it's not going to get there, but on paper, that's theoretically how low it can go. You have to be a little bit careful with these, especially with the enhanced or juiced ETFs. They're using futures contracts and options, and they have to rebalance this every day, and sometimes they don't get it quite right. Personally, I don't use inverse or juiced ETFs or enhanced. I do with mutual funds. They seem to have a better track record for keeping that peer relationship going there. I would rather use options personally because I think there's less risk involved in that. But that's how I come out. You may come to a different conclusion. So you buy a put option if you think that the S&P is going to go down. And I did check the price as of Friday's close. The put option that I would be watching that's 30 to 45 days out, it would cost you $700 to do that. Okay, you could also enter a bear put spread. Remember when we did the bullish call debit spread? Well, here we do a bear put debit spread. We're just doing the inverse of what we were doing before, where we buy an option, we buy a put option at the money, and then we're going to sell a lower put option below that. And if the money that you outlay would be about $700, the money that you bring in would be about $400. And I know there's a discrepancy here between calls and puts. Typically, calls are more expensive because more people do that, and they have dividends that figure into that whole. They have this Black-Scholes model pricing thing that they use to try to determine what options should be worth at any given time. And call options tend to be more expensive than put options. So it would cost you less to get into a bear put debit spread, $300, but then you also have a potential for a higher profit. It maxes out at 4,700. So a little bit more that way. But again, we're looking at 20% and out. Again, you might want to ride it longer than that if something's really going your way, but you're going to top out at the 4,700. And then you can sell credit spreads above current prices. Just like we sold the credit spreads below when we thought we were going to go up. Well, now we're selling credit spreads above the price when we think the S&P is going to go down. And you would bring in about $300 for that, but that would be your maximum profit at that point. You get your profit right off the bat, and then you have to see how much of that you get to hang on to going forward. And then usually how we close these out is we buy them back. That's how we close them out. So you might sell it for 300 and then buy it back for 200. And that's more than a 20% gain on that right there. So we watch this over a period of time. And when we get to that point, we get out. Now we've got another $100 that we've made. We can put that into our program and start letting compounding then build things going forward from there. Okay, and then I have these in italics because I don't really implement these to the downside where you implement calendar spreads. I don't do that because they go totally against logic, and they go totally against longer term what the market ends up doing. Bull markets tend to last longer than bear markets. And I don't want to get caught in one of these strategies where I'm hoping that things are going to go down and I run out of time because we've switched back over into a bull market. That's where I come out. You may reach a different conclusion. I also don't do covered calls. Believe it or not, you can short the S&P, and instead of selling call options, you're selling put options. And then that's a way that you can generate some income when things go down. I don't do that, but it is a strategy that is available to you. All right. And then you can also implement, it actually should be a married call instead of a married put. That's a typo right there. Where you're buying a call option if things go against you. Like we're using protection when we're going to the ups. If we're hoping that something will go up and it goes down. Well, here we're hoping something will go down, and the call option will limit if things go against us that way. So it's just an inverse of the same strategy that we were talking about before. And I want to give a quick look at the clock. Okay. All right. And then we have some non-directional strategies. And back in from about 2005 up until we hit the financial crisis, we went through a long time in there where the market was just chopping around, and it was going higher. And in 2007, it had a really good year. Then we just tanked after that. And then about 2013, after we hit a bottom, 2014 up until about the Brexit happened, and then we had the 2016 election, and that kind of caused some jimmying in the market, both of those events. But for a lot of that period of time, the market was going higher, but it was chopping sideways. There wasn't a real strong trend behind what was going on. What you had is we were getting out of the financial crisis, and you had a lot of institutional money coming in, and you had interest rates very, very low, and you had a lot of propping up of the market during that time. And that keeps the market going up slowly, but not really trending at the same time. And so these non-directional strategies were really popular during that time. And of course, all the different people out there, they latched onto this. They started marketing this as some kind of a tool that you can use. And by the time people were learning about this, it was just about the time this period in the market was finished. And we were going to back more of a trending environment where these non-directional strategies, you wouldn't be implementing them. And yet people are learning about these things, starting to implement them, but their time is kind of come and gone at that point. And so people are losing money and they're like, forget this stuff. I'm not going to do options. These guys are just not telling me the right thing. That's why we watch things every day, because right now, for the last, ever since the COVID plunge, I haven't done any sideways strategies. I sell credit spreads and I do debit spreads, either with calls or puts, but I haven't done any of these types of strategies because we've been pretty, even though we chopped around in 2022, we've been moving kind of strong to the upside and to the downside. We haven't really hit these extended trendless times. Okay, but these are non-directional strategies that are implemented when the market is going sideways. Late in 2022, between Christmas and New Year's, we were chopping sideways, but that just lasted a short time. Lately, before we had this little run up going into July, we were chopping sideways a lot then too. Just up until this last week, we were going from a negative trend back over to a positive trend, and we tend to hit some sideways situations while that is changing. Now, we don't know. Tuesday may open and we might just tank, but things that as they look right now, they look like they are improving. But when we go extended periods of time, this is when we want to implement these kinds of strategies. We can sell covered calls at that point. And people make a living doing this, where you buy a stock and then you sell a call against that. And I've kind of covered this before, but sometimes you might want to wait on that, because if you sell a covered call immediately and it goes up, you're going to lose that stock. And maybe it's a stock you want to hold on to. Now you're going to get all your money back and you're going to keep what you generated by selling that call. So it's not like you're losing anything. But if you have a stock, and I'm kind of go back and forth between stocks and indexes, but let's say you work for Boeing. Okay, they're big in the Seattle area, or Starbucks or Microsoft, and you've owned that stock for a long time. You may not want to get rid of it. You might want to generate some extra returns. So you might sell some calls against that, but you don't want to have that call exercised against you, because then you would lose that stock. That might produce a taxable event. And it may not be what you want to do in that situation. So you might want to wait a little bit, or sell a call so far up that you think, there's no way we're ever going to reach that. But that's, again, you're kind of dealing with your emotions at that point. But you could do that, okay? Especially when we're starting to go sideways, because we're not really in as much danger of actually going up and hitting that strike price. And you may want to have that happen. Well, I did covered call writing for a living for a number of years in the early 2000s, and I wanted to get exercised. I wanted to sell the calls. The calls were how I was generating my income. And then when it got exercised against me, I'd get my money back that I paid for that particular stock, and then I would use that and then go on to the next one. So, I mean, there's advantages and disadvantages to each side. You can also sell credit spreads. Now, you could sell above the price channel that we're going in. If we're going sideways, you could sell some credit spreads above, and you can also sell some credit spreads below. Now, you got to be careful, because if we start screaming up or down, you're going to get hit and maybe taken out with those credit spreads. So there can be some additional risk with that type of strategy. In a perfect environment, if we continue to go sideways, you can make some pretty good income doing that. And this is a way to benefit when the market's really going nowhere. And you can do a thing called butterflies, which is a combination of a debit spread to the upside and downside, where you're trying to hit a target. And people like this strategy because it's not all that expensive. What you're buying and what you're selling kind of almost cancel each other out. And these can be pretty inexpensive positions to get into. The problem is it's like you're looking at a bullseye. You need the market to close within a particular area for this to be successful. So there's a reason why they don't cost as much. Now, when you're right, that can be really nice, but you're pretty much limiting what the market is going to do. And this is not always the best thing, okay? But they do have their place. And then this is kind of the thing that became the craze back from about 2014 up until 2016 or so. This is a thing called iron condors. This is what I did implement during that time. but I'm not implementing them now because we're in a more trending environment where you sell a credit spread above and below at the same time, and you bring in a credit from both sides. The problem with that is you might get taken out on the upside or the downside. It's a market neutral strategy, and you can make some good money doing this, but there is some risk in here. And so lately, I've just been selling below when we're going up and selling above when we're coming down. You can add this later and possibly bring in some more credit with that if we're getting far enough away. But at the same time, you can also take on more risk, that because people were getting into iron condors thinking this is easy road to riches here, and you're fine as long as you stay within that range. But if it comes up and takes you out either up or down, the risk to reward with these things is pretty high. And so you might bring in $200, but you might end up losing $4,700 or $5,000 or something. So it can really be devastating to an overall strategy. So they can be good, they have their place, but we want to be sure that we're implementing them at the right time. And that comes back to evaluating where the market is. And because you have so many people out there, they're just doing these strategies. They don't really care what's going to happen. They just keep rolling over until eventually they either break even or make some kind of a profit. You're not going to get rich doing that. The way that I do things, I think, is much more advantageous, taking smaller profits and then putting it into the next position and then letting compounding really take over at that point. But that's where I come out. You may differ from that. So the market may be going sideways, but it may be looking to break out. So there are some different strategies that you can implement that can be quite successful, where we're going, the ADX is below 20, and that's suggesting that we're not in a trending environment. And you think, okay, there's something big coming up. A lot of people use this strategy when earnings season is coming up for stocks. Now, we don't really have that as much with the S&P because all the stocks are coming out with their earnings at different times. But you're looking for a big move or down, but you're not really sure what's going to happen at that point. You can implement a thing called a straddle, which is where you buy a call and a put at the same strike price for the same month. Now, this is probably the most expensive option strategy that you can implement because you're buying a call and a put. But, okay, I kind of hesitate to say this. Whoops, somebody's coming in a little bit late here. We'll see. I'm not going to say that for right now, but there's one time I was doing a straddle and I didn't know. It was on the S&P. I didn't know what was going to happen. And so I bought a call and a put at the same time at the same strike price. It was good for 30 to 45 days. And the market we gapped up so high from one day's close to the next day's open that I hit my profit target on the call side of this strategy. So I sold the call, but I hung on to the put because it was pretty much worthless right now. I couldn't really sell it for anything, but I just decided, okay, I'll get rid of the call. I'll lock in that profit. Well, then what it ended up happening is let me back up a little bit. You remember when I said you don't want to open positions at the open of the market? You want to do it at the close? We can take full advantage of closing a position at the market open, especially when we have a gap looking to go up or down and it's in our favor. Okay. So we can use the open that way, but we don't use the open to get into a new position. We might use it to get out of a position. And so what happened is immediately after the open, I sold the call. Well, we gapped up so much that day that we just spent the rest of the day going down. We went below the unchanged level, and we just went down. And we ended up going into a pretty significant downtrend. This was right in the beginning of the year. It was like the first trading day of January. And everybody was all excited about the market. Well, they got overexcited, and the market has a tendency to go in the opposite direction. I made money on both the call and the put. I sold the call when we gapped up, and then it was a few days later, we just kept going down. And suddenly this put option that had been worth nothing, suddenly it went in the money, and I was able to make a profit on both sides of that. Now, I can't guarantee that that's always going to happen, but those things are possible when you're doing this type of strategy. And you don't really know So that kind of takes some of the pressure off. Okay, so straddles can be good, and there's a variation of this called a strangle, where you, the straddles you buy at the same strike price. Like right now, we would buy a 450 call and a 450 put on the SPY. Well, maybe to make it a little bit cheaper, you might buy a 455 call because that's a little bit out of the money, and you might buy a 445 put because that's a little bit out of the money. So your outlay is a little bit less. Now you have that spread in between the two where you're not going to make anything. You're going to lose them both. But that does make your initial price less, because when you do a straddle, you're paid full price for the call and full price for the put. And you look at that and go, oh my gosh, your break even point can get really out of line with those things sometimes. So again, you got to be careful with all of these things. This is like driving a car. Okay. A car can be very useful and a very good thing to take us where we want to go, and to visit our friends and to get us to work. A car can also be a weapon. We can use that car to kill people. We can run people over. We can, remember 9/11, what they do with airplanes. Okay, you turned them into weapons. The same thing is true with these strategies. There's a safe way to do this, and there's a dangerous way to do this. We want to be aware of that, and we want to respect that, but we also don't want to be afraid to take advantage of the good things that can happen. Cars are dangerous, but we still take advantage of them every day by riding in them and driving them. But every time we get in a car, there is a chance that it may not work out all that well. But that doesn't stop us from using the car. All right. Here is a chart that I put together. How are we doing here for time? Okay, we're about 3 minutes after the hour. Did I see that right? So we're actually going a little bit quicker than I thought we would be doing here. What I tried to do on this chart, and there'll be a PDF of this available for you to download. And you might want to look at this chart, because this is the actual S&P. And this line over here on the side, this is when I started putting videos up on YouTube and Rumble. It was like January 18th. It was right after Martin Luther King Day. I've been doing videos forever. I just wasn't making them available on YouTube. I would just watch them myself, or I'd run them on a private website. And then I decided, because this is kind of the bread and butter to what I do, are those daily videos. And I'm like, do I really want to just make those available for free to the public? I put a lot of work into these things, but it's been the best way that I found to kind of promote what I'm trying to do and to promote the channel that I'm trying to build. And so I've just been kind of going with it. But the red line, that's when I started posting. And then this is what I tell people to do. Look at a chart like this, and then just go back and look at some of the videos that I posted from early 2022 up till now. What was I saying when we were hitting a top? What was I saying when we hit a bottom? See if what I'm talking about is legitimate and worthy of you even paying attention to. And I think you'll find the answer rather pleasant, to be quite honest. I'm never dogmatic about my conclusions. I say, okay, the probabilities are that we're going to go up. But at the same time, these are all the warning signs. These are the things that we have to watch out for at the same time. And we need to respect those, because things can turn against us. Okay, so I try to play both sides, and this is part of what I had to do to overcome getting caught off guard. Okay, we might just be screaming up like we did here back in July of 2022, but then we hit, and you don't see it on here, but that's the 200-day moving average. Can you see where my pointer is here? I don't think I can turn on a laser pointer, but right at the top, this was the 200-day moving average. And if you were watching my videos at that time, I was pointing that out, that, yeah, we're looking really positive and really strong right now. And this is also about the time when Chair Powell gave the speech at Jackson Hole that just freaked the markets out. It actually fell down a little bit. This was the big downward move after his speech a year ago. That's why the market was spooked out when he gave that speech, what was it, week before last? Because they thought he was going to say something that was going to freak the markets out again. And but go back and test me and see, what was I saying here in the bottom in October 2022? This looks like the bottom. Now, based on where we're at over here on the right-hand side, we could come down and take that out. And there are people, believe me, the perma bears, that's what they're declaring. But when we look at the evidence of what we're being presented with here, we're looking pretty stinking good right now. Now, that could change at any time. And we're also coming into a seasonally weak time where September really sucks as far as returns. It's the worst calendar month of the year. And here we are with the third worst month being August. Okay. So we're coming in out of a one difficult time and going into even more of a difficult time. We use that. We want to know about that. But at the same time, we don't let that control us. We just say, okay, I know that's there. I know that this has happened before, but I have to look at these charts to have them tell me what's actually going on. But what I did on here is I just marked if there's a green arrow, that's when a debit spread was initiated. And notice that it's never right at the bottom. It's kind of after the bottom. And then when I have a red pointing arrow going down, that's where I initiated a bear put spread. Okay. And then we went down after that. And a bull, I always have to think this out, a bear call spread. So you can just see these are the types of strategies that you can implement. And this was a difficult time. 2022 sucked for most people. It was the best year I ever had because we were jumping around all over the place. We were moving just far enough to get in some really good gains to take advantage of some compounding, where most people are just going, oh my gosh, we're just going down here. I'm losing the value of my portfolio. I'm just going, bring it on. I love these sharp up moves, these sharp down moves. You can really take advantage of those. And you can get some really nice returns during times like this. Okay. And then when you see the X, that's when you sell a credit spread down here. That would be a bullish credit spread because you think the market's going to go up. And if it does go up, this is just going to expire worthless. You're going to buy it back at a much lower price and have a pretty good return. And then the orange X here, this is when you sell another credit spread, and then the market tanks after that. And then you can buy it back at a lower price later. And if you're really adventurous, you can let it expire worthless. That's where you would get to keep all of the money that you bring in. But again, I do things a little bit different. So just looking at this, can you see all the different opportunities that you had? Well, I go back pretty much to when I started doing the videos. It's not fair of me to go back further than that because you can't really check that out. But look at all the things that you could do. Now, and like in this area, back in 2023, when we hit the bottom in March and we started going up and then we chopped sideways and then broke out, I have one X right here. That's not all I was doing. I was selling credit spreads all the way up as we're going up higher. I'm also buying more debit spreads as we're going up too. The arrows and the X's are just where I initiated something new. You can then add to this, and if the market is continuing to go in the direction that you want it to, you can open up more positions. And that's when this thing really gets screaming with some really good potential for what's happening. So even though you just see one X here, it doesn't mean that's one position. That's the beginning of a series of positions after that. And then we came into the latter part of July. We started to see some weakness coming into the market. We hit a top, and the last area that I'm going to talk about is support and resistance. We hit resistance right at this area up here, and then we had a really difficult August. Well, it wasn't difficult for everybody. You could sell a credit spread up here, and then it's going down, and that thing's getting worth less and less and less. You can buy it back at a lower price. You can do some put spreads, debit spreads, where you're going down here. You can be adding to those positions as we're going down. And now it looks like we're turning back and looking a little more positive. Okay. So you can see all the opportunities in here. And this is just implementing a few strategies. I'm not including covered calls on here. Let's say if you bought the SPY down here at the June 2022 low, first of all, you'd be a genius for doing it right at that time. But then you're like, okay, I buy my initial put option because the market was, it still was going down at that point. and you had a lot of disbelief. See how choppy we were right after that? But let's say you got in at that point, but you're willing to jump in because right at the time you get in here, you're buying a put option at the same time. So you know that if this really tanks against you, okay, I was wrong. I get my money back. The put option will cover what I lost in the SPY. See, you're willing to be a little bit more daring when you know that if you're setting things up the right way, that you have some protection. And then let's say that things did go your way and this put option were going up and up and up. It expired. And now, by watching the videos, by evaluating the market, by seeing this 200-day moving average, which is not on this chart, but believe me, it's there. And you go, okay, right when we hit that 200-day simple moving average and we start coming down, right about in here, this is where I'm going to sell my covered call at that point. And I'm going to sell it at about 425. Well, let's say 420. Okay, well, right, and you're going to bring in a really good chunk of change for that because you're doing it at the money call at that point, and you're probably going to, and the market's really been going up, and so options are going to be more heavily priced or higher priced at that point, and you're going to sell that option, and then look what happened after that. Whoa, we just tanked down, and that call option that you sold is going to expire worthless, but you still get to keep that money that you used that you sold. You not only keep the SPY that you bought down here, you were protected on the way up, and now you sell the call option here, you generate some more income, and then we start to hit some problems. You could buy more puts. And see, this is also a way by selling covered calls, you do what's called a caller. And I don't have that on the list, but it's where you buy, you get into the SPY, you buy a put option that protects your downside, and then you immediately sell a call option, and that helps to pay for the put option. So yes, you're limiting your gains to the upside, but you're also, it's going to be less outlay for you to apply that protection on your position. And we call that a collar. And that's another one of the strategies that I present in the course. So again, look at all the things you could do in here. That's why you could be really busy. The market, we've been going through the dog days of August as we've been going lower. Well, it can be some exciting times if you know what to do at the right time. All right, I think I've hammered this enough here. All right, let's see. Let's get on to support. Oh, developing a daily plan. The plan is for the next day that we develop, and then I don't deviate from that. I don't come up on the fly with what I'm going to do. And then at the end of that day, then I fall back and I say, okay, what do I need to adjust for the next day? I found that doing things intraday, that's too quick. Doing things weekly, that's too slow. For me, what has worked over the years is modifying and reevaluating this plan every day. That's why I do videos every day. I have a lot of people that tell me, well, just do a short video and then one long one where you go through all the charts. I really struggle doing that because I need to look at everything every day. And that for a while I was doing a longer video and then I was doing a shorter video, and then it was taking me forever to edit both of those. And now I'm doing this where I'm just hitting the button and recording things and going forward from there. I need to follow what's going on. And that has really helped me an awful lot. And that's why I can't make you watch the videos every day, and you probably can't watch the video. There's days I can't do the videos. I might be sick. I might be traveling. Something might come up. The power might go out. We might get hit by a nuclear bomb here. I don't know. But my intentions are to do the videos every day. And I do them when I can. And that's most of the time. So anyway, all right. Okay. Then the other thing, just as a side note, I really don't share what I'm doing explicitly on a personal level. I may say I'm net long, I'm net short. I'm not trying to start a religion here. I don't want you to just blindly follow me because I've got more experience than you do with this. My goal is for you to develop a skill so that if I'm not around for some reason, now I want us to work together for 10, 15, 20 years. But what if we don't have that long? What if I'm not around? You now still have a skill that you can use independently from me. I'd like to work with you for a long time and develop a relationship, but at the same time, we have to be realistic, understanding that things can happen and they do change. Okay, and I have to keep moving this around so I can see the writing here. If a new position is to be opened, everything is planned out ahead of time, like the desired profit, the loss that you're willing to take. I'm kind of reiterating what I said before, the time in the position. We plan all of this out. All of the things that we can control are planned out ahead of time. And then at the end of the next day, we reevaluate things. And then we have a new plan sheet that I have available for members where you can go in and whether you do it on the computer, I have a PDF that you can use. There's a spreadsheet you can use. You can print these out and actually write it down, however it works for you. And you might keep a little notebook of all these different sheets for each day, so that when we have our weekly meetings and we debrief, you can go back and look at your notes and go, oh yeah, that's what was happening. I even have an area on there where you can take notes about what happened, maybe any economic reports that came out. As you're watching the daily videos, different notes, things that you pick up that I'm talking about in the videos that you might want to make note of, that you can easily refer back to help justify the decision that you're trying to make.